After years of growth, big tech is facing a roadblock. Creating growth is already hard enough for companies, but creating consistent, strong, year-over-year growth for an extended period of time is the true test. If you invest yourself or watch the news, you probably would have heard of the term growth stock or even a growth company, and majority of the time they're speaking about tech companies. And at the front of that, you have big tech, which includes the likes of Apple, Microsoft, Meta, Amazon, and Alphabet, to name a few. Big tech's recent slew of cancelled projects, staff reshuffling, and calls for efficiency is no accident. Rising interest rates have focused investors on short-term profitability, and companies such as Amazon, Alphabet, Meta, and Snap are responding. Amazon's long-term telehealth bet is finished. Facebook's new project experimentation unit is shrinking, and Snap's selfie drone is toast. And for years, these companies' stocks soared, destroying the market and growing at unparalleled rates. But as the largest parts of the world face the possibilities of a recession and interest rates rising, is this the fall of growth stories for big tech, or is it just a bump in the road? Alphabet shares dropped about 7% in extended trading on Tuesday after the company reported weaker than expected earnings and revenue for the third quarter and said it would significantly decrease headcount growth. The earnings per share was $1.06 versus the $1.25 expected. The revenue was $69.09 billion versus the $70.58 billion expected, and YouTube's advertising revenue was $7.07 billion versus the $7.42 billion expected. Revenue growth slowed to 6% from 41% a year earlier as the company contends with a continued downdraft in online ad spending. Other than the one period early in the pandemic, it's the weakest period of growth since 2013. YouTube ad revenue slid about 2% to $7.07 billion from $7.21 billion a year ago. Analysts were expecting an increase of about 3%. Alphabet reported overall advertising revenue of $54.48 billion during this quarter, up slightly from the prior year. Philip Schindler, Chief Business Officer for Google, said the company saw a pullback in spend on search ads for certain areas such as insurance, loans, mortgage, and cryptocurrencies. The report marks an ominous start to big tech's earning week for investors focused on the digital ad market. Last week, Snap issued a disappointing results and said it was unable to provide a forecast given the volatility in spending and concerns about the economy. Snap plummeted 28% on Friday following these numbers. But Alphabet wasn't the only tech giant to fall, and won't be the last. Microsoft shares fell about 7% in extended trading on Tuesday after the company reported softer cloud revenue than expected in its fiscal year first quarter and gave weaker quarterly guidance. Here's how the company did. Its earnings was $2.35 per share versus the $2.30 per share expected, and its revenue was $50.12 billion versus the $49.61 billion as expected. With respect to guidance, Microsoft sees $52.35 billion for the fiscal second quarter, which implies 2% growth at the middle of the range, which falls short for the analyst guides. In the fiscal first quarter, total revenue grew 11% year over year. Cyclical trends are affecting Microsoft's consumer business, their CEO said. On the conference call with analysts, net income fell by 14% to $17.56 billion. When interest rates were effectively zero, the dollar in hand returned nothing over time, so investors gave the tech giants leeway to invest billions in initiatives that probably wouldn't pan out immediately. With rates rising, there is now an opportunity cost to that money, so big, long-term bets are now more consequential than ever. Meta's metaverse wager must work. If it is wrong, or signals that it's lost even a little bit of belief in its vision, things could get ugly. As tech giants work to become more efficient, They might also lose their more entrepreneurial employees, and companies filled with people who work on safe projects often become less innovative. Meta, for instance, is shuffling departments amid a ruthless prioritization and giving some employees 30 days to find new teams or leave. If you're on one of those with a really unique team, perhaps it's not actually a good skill set match within the company, said one of the workers who worked for Meta's portal until January. It's a soft way of firing people. This doesn't bode well with employees willing to attempt projects that might not work, which is where the best inventions often emerge. So realistically, what does the future look like for these big tech companies? For these cash-rich large companies, they should be able to restructure, cut some expenses such as research and development and unprofitable ventures, but the real ones that will suffer are the small tech companies as funding dries up and people look for safer bets. With Apple, Meta, and Amazon still to report earnings, do you see similar occurring with them as what has happened with Microsoft and Alphabet? Hopefully this video showcased what's been happening in big tech and some of the reasons why your portfolio might be looking the way it is. Leave your thoughts on the future of big tech and if this is just a small bump in the road or not. For more business and finance content, subscribe to Business Ventures.